Grain Advisory Group. This is a follow-up from our meeting back in September. We have been tasked with convening this group to discuss financials and bonding. Specifically, very specific language from the legislature last year, which was convene the group to develop recommendations regarding financial statement and bonding requirements for licensed grain buyers and public warehouses to better protect farmers who sell and store grain here in the state. So for those that are new to the call, last time we discussed financials and bonding, and we went into a little history of the program and what led us here. We currently have an indemnity fund in place here in Minnesota. That's a drastic change from the previous system that we had, but it has left some questions to be answered here around bonding and financials. And so my hope here today is to do a little recap of what we talked about last week, and then we've got some sureties on the line here, or representatives of the industry that can help shed some light on some of the questions that we had around bonds last year, or last time we met, and help us inch closer to developing some recommendations. So with that, I just want to run into the recap from last time. So I divided this up into two brief slides. If anyone wants to dive into some of these things, feel free. We've got an hour scheduled here, so I do want to leave some time for questions for the representatives from the sureties. So from the 23rd meeting, we talked about the financials and the compliance that we're seeing in reporting financials here in Minnesota. The requirement is that if you are purchasing less than $7.5 million worth of grain, you need to submit a reviewed financial statement to our office. And if you're purchasing more, you need to have an audited financial statement. As a reminder for those that were on the call, we are not reviewing those or evaluating those statements in any way. We are making sure that they include the 7 requisite items that are listed in statute, but there's no evaluation of those financials or action that's triggered by something that we would see in those financial statements. We're hearing about a lot of issues with logistics of even getting financials or the cost, both being prohibitive and making it very difficult for people to comply. We did hear some benefits to it, that financial reporting has created a standard for accounting. And I really liked, I think it was James said that financials act like a lock on the door. It's not going to prevent theft or fraud, but it will do best to kind of keep people away, or at least act as a deterrent. So again, we're not evaluating it, but there is value to some of the financial reporting, is what we heard as well. If we were to evaluate it, we would likely need to staff up or add at least one staff committed to evaluating these, because we're seeing roughly 300 financial statements a year from all our entities. And so that on top of the enforcement, and if there were some metrics there for monitoring, we would have to take that into consideration. And then the burden isn't equitable across the whole industry. Some facilities are already doing audited financials, and so this was a very easy lift for them. Some were doing reviewed financials, again, easy lift. But for many, we heard that this is a brand new requirement. They weren't required to do any financial reporting. And so to go from 0 to 60 or 0 to a review or audit, that's a very big change to their current business practice. And so one of the questions we had is there a way to create an even playing field? Maybe it's changing reports for smaller entities. Maybe it is using current ratio or some other metric to level the playing field so that the department can really evaluate these. And I'll jump into the ratio here in just a little bit, because we had an ask around financials to hear what other states are doing. Any comments or questions on what we talked about last time? Just jump in here. We were asked to take a look at what other states are doing. And so we went to some of our neighboring states. That's typically the case, what we will take a look at. And We've got requests out to each of these states to provide written response to several questions, but I went through the statute of each of these states and kind of evaluated what they require and how it compares to us. So in Michigan, Minnesota, North Dakota, South Dakota, Wisconsin, all of these states require financial reporting in some capacity. Most of them, with North Dakota being the exception, have a standard of audit or review. And there are some exemptions or exceptions to the rule, and as is the case in Minnesota, right? If you're buying with a cash or cash equivalent here in the state and paying immediately upon delivery, then you would be exempt from financial reporting. Well, North Dakota allows internal reporting rather than an audit or a review. But they require monthly reporting to their office, so much more consistent monitoring. Several other states require the annual review, so similar to what Minnesota is doing. South Dakota requires a quarterly review. Christine has been part of these conversations, so Christine, please feel free to jump in if you have anything to add.
Definitely.
Some have exemptions for this reporting, some do not. Some use a threshold, like Wisconsin, for under 200,000 bushels purchased annually. Some say, no, you absolutely have to report this regardless of the business you're doing. And then you can see South Dakota has a trigger that anything purchased above 5 million that requires a different level of reporting, much like Minnesota at 7.5 million. Wisconsin uses a threshold of bushels rather than dollars. So we also have bonds that are required in some capacity for some of these other states. Michigan says that you need to have a net assets or net worth of $100,000, and if you don't, then you need a bond to like bridge that gap. Minnesota requires new entities to hold a bond in $100,000. North Dakota, South Dakota, they have different systems for bonding as well. South Dakota is similar to what we were doing in Minnesota pre-2023, in that everyone needs a bond, but their scale was drastically different. Wisconsin is similar to what we're doing now, new entities requiring a bond. So one of the things that isn't on this chart, and I jammed a bunch of information here on one page for ease of digestion, but we talked about how are states reviewing these financials, and some have it spelled out in law on how they're reviewing it. Some, like South Dakota, are just evaluating it and monitoring it, and they've taken the approach that, like, if they have concern, they can step in and really make sure that the company is on the right path here. So in Minnesota, traditionally, you feel more comfortable with a prescribed action and a prescribed threshold that we would want to take action for financial information. We talked about that a little bit last time, but other states are a little more liberal in their applying of the rules. So what I looked at with several other states that aren't listed here is what they're using to evaluate. And I'd say current ratio of 1-to-1 would be the like industry standard. And I'm skeptical in saying industry standard because it's not all states, but those states that do have something in writing is typically current ratio. Some are looking at debt to equity. I saw 3-to-1 debt to equity. So nothing universal, but there are some similarities across other states. The one thing I do want to call out is South Carolina has a system, and we mentioned it briefly last time, which says that if you don't have a financial statement, then you need to file a bond with our office. And so we talked about that a little bit last time, in that bonding and financial statements do walk hand in hand here. And so South Carolina's approach here is, let's say if you can't secure a financial statement, or maybe it's a smarter business decision for you to get a bond and have your surety review your financial viability or your financial position, But as long as you can do that, then you don't need to file the financial here with our office. So, any questions on this? All right, so I want to jump into the bonding here, and this is again the recap. Oh, Frank, go ahead.
I I had discussed having them raise the bond amounts so that we could buy this audited financial. I just paid for mine, and I would be happy to pay way more than I was for the bond than to pay for that audited financial.
Right. Yeah, I mean, the bond is going to be a significantly lower annual cost than your financial, depending on the level of the bond, right? But we've typically seen bonds run between 1% and 5% of the value of the bond. We have sureties on the call here that are representatives of the industry that can maybe speak to that now or later. But your audited financial, we're hearing 10, 15, $20,000 are
or
standard more for pretty small facilities. And so that at 1% to 5%, that would be a very significant bond. Our highest bond required prior to the indemnity fund implementation was $500,000. So 1% of that is $5,000. 5% is 25,000. So, yeah, drastically different here. So some of the other things that we talked about, and this gets into the bonding component, is bonds and financials walk hand in hand, right? One of the things that we heard leading up to the indemnity fund and after it is that bonds serve as a screening tool. It's a third party reviewing this company, and if you get a bond, then there is money that can be used to pay any obligations that haven't been met. So with that, with the requirements of the bond going away, well, now there's this vacuum of financial review. The department isn't doing an assessment or evaluating using ratios or some other metric, and the bonding companies or the sureties aren't doing that either because they're no longer required to. And so there's this vacuum of space where there's potentially no review of that financial position happening. And we heard from several of you on the call today that you like that system in place. You like having a third party that can come in and review your process and take a step back and maybe it's not an endorsement, but it's certainly another set of eyes on the process that you have at your facility or across your enterprise. But we also heard that licensed and bonding has this perception from people who are selling grain that there is a financial screening. And there may be for many of our license holders that were bonded, but we also heard from some grain buyers that sit on this committee, as well as others that have called our offices, that they went years and years without ever having to file financial information. We heard from, and I've mentioned this anecdote before, but that all they had to do was write a check because the bond amount was such a small amount, $10,000 was their lowest bond, that they just wrote a check and the surety would issue their bond or renew their bond year after year. We've talked about it before, but the bonds are our screening tool and marketed as such, but the screening isn't uniform across all companies. It probably shares some similar components, but that's proprietary information between those companies, and I'm sure that they don't want to share exactly how they're evaluating each company, and because they're in competition with each other. But what we heard is, from our grain buyers and our license holders, is some of them were submitting their audited financials to their surety every year for review. And then back to the same thing, other companies were just submitting checks. And so there was this perception out there that people were being held to the same standard. And if I'm being honest, a false sense of security that people were being held to the same standard because people heard bonded and licensed. And that the definition of that, it wasn't the same across all entities here in the state. And so one of the things we've talked about this year and previous years is if we change the value, the levels of the bonds from 10,000 up to 500,000, does that require the sureties to do a more in-depth review? We heard several years ago in having people come to this advisory group at probably 2017, 2018, that like the values and the levels of our bonds were so low that in some cases it wasn't a great, it wasn't a viable business decision or worth the investment to do an annual review of these companies for a $10,000 bond or so. So if we were to change that and increase those levels, would that mean that we are then kind of forcing the hand of the sureties to do a more consistent review? And I already covered the vacuum of financial review. So again, 15 minutes to recap a 2-hour meeting. I know I didn't capture everything, but if anyone has anything they want to add or thoughts on kind of what we've covered over the last couple slides. Yeah, Frank, go ahead.
In the case of a facility that has product that is prepaid by the customer, like say in my case, the canning company, and so they own all the product in the facility, I have to carry insurance on that product because I have it. So in that case, you have to have insurance on the product. You can't get away from having the bond, as it were.
Well, Laura, maybe you can chime in, but we've traditionally heard that bonding is not insurance, that it's a separate product. And so the bond doesn't intend to serve as insurance, but maybe I can open the floor to other people who are a little more familiar with with bonds versus insurance and some of those products and how they differ.
I would imagine that's correct, but you have to have the storage bond to store product.
So in Minnesota, you can hold a Minnesota grain storage license, and the requirement right now is that you do not need a bond to store grain. You do need to have it insured, but you don't need a bond to store grain using a Minnesota storage license. If you are a federal warehouse and you hold a federal license, you absolutely do need a federal bond.
Okay.
Yeah, Frank, that changed July 1st. So if
okay.
Yep.
Well, I just was kind of curious on the overlap of that, because there's the oversight part of it, making sure that you're crossing all your T's and so on.
Yeah, and it's an important call out that we do have requirements for insurance to protect against the loss of grain due to fire or some other things. It looks like Adam has a question.
Hi, this is Adam Brockmeyer with the Surety and Fidelity Association. Nick, you may be aware that there's a significant difference between insurance and bonding, and that is when it comes to paying claims, a bond will pay a claim, but then it will seek reimbursement from the contract holder for reimbursement. It doesn't pay money that comes out of a claims fund. So when a grain elevator is bonded, let's call it an insurance company is taking on a financial obligation with the expectation that the grain elevator is going to reimburse the surety for whatever it pays in damages to a farmer. I got a list of some questions before the meeting here. A financial review of the company, the surety is going to do its due diligence. And again, the due diligence is going to vary significantly on the size and scope of the grain elevator. I've got a high school baseball teammate who owns a grain elevator operation in Glenwood, Indiana. It's a small family business. He doesn't have an army of CPAs, and the sureties are going to be flexible because they understand that the size and scope and sophistication of every business is different. But the financial guarantee is something that they're going to need to see some evidence of financial viability from the grain elevator before they issue the bond. And when it comes to underwriting and what processes they use, I suspect every company is just a little bit different, and every company is going to have a little bit of a different process for all of the grain elevators, because there's a big difference between what a small business does and what a large business does. So I hope that's somewhat helpful.
Yeah, that's very helpful, Adam. I really appreciate you joining the call today. And the questions you have, I actually have as the subsequent slides. So I'm hopeful that you or one of your colleagues from industry can jump in and answer some of these questions, because this is exactly the kind of information and context we need to help shape where this law goes and what we do with this law. So I do have a question, Adam, based on your response there, though. It ultimately, like, let's say it's $100,000 bond, you're evaluating the viability of recuperating that $100,000 in the event of a failure, right? It's what is the risk to our company, and I assume that each surety is a little different in saying, are we willing to take on a higher risk or lower risk, those sorts of things. But does it boil down to, okay, what's the viability of the company today, as well as what is our likelihood of recuperating this bond amount?
Yeah, this is going to be this is a tough question. And I tell you, if I knew the precise answer, I'd be running my own surety. But the sureties are going to evaluate a number of companies that fall into, let's say, gray areas where there could be concerns, and there may need to be financial monitoring throughout the year and additional consultation to help companies get to where they need to be, so that they can be bonded again next year. So there may be some difficult conversations with companies. Hey, you've been clients of ours for years, but we're noticing this in your financials, and we need to work together to figure out a path to move forward together. So there is some management coaching assistance that the surety wants to provide, because the surety has a financial incentive that its client stays in business, because otherwise they don't issue the bond and they lose a client. So it's easier to keep the client happy and keep the client in business than it is to just deny the bond and walk away.
Yeah, and it's a good reminder that, of course, like these are independent companies that are picking and choosing that risk. And when we're writing legislation, we're essentially saying this is the bare minimum to operate here in Minnesota. And so, like, a company A or surety A and surety B may say we're not willing to take on that higher risk. But if we are writing legislation here, like, we need to acknowledge that we're creating a baseline for performance here in Minnesota. I hope that makes sense for those on the call that are helping to contribute to some recommendations here. So if no one has any questions about the recap, I would love to jump into the questions that we sent on to industry to help provide some context. And there's certainly people on the call here that I invite to jump in with their own questions. We tried to summarize the questions we had after the last meeting we had in September, and kind of build on those to send these along. And so, Adam, the questions you saw, they're no different than what I'm going to put on the screen here. But I'm hopeful that you can jump in, or Laura, you and I talked a little bit about maybe you can shed some light on some of these questions too. So with that, I'm just going to jump into those. All right, so the first one is very basic. Like, what does the bond intend to do? In your terms, what are the advantages and disadvantages of the bond, and what are it's a pretty simple question. I'd like to give a summary of what we've heard, about this in the past, and in very simple terms, it's a screening tool. It's a tool that's flexible in that it may be a small operation, and the surety is taking that into account and maybe requiring less in reporting. They're looking at tax filings or personal bank statements, and evaluating the risk, versus something for a multi-billion-dollar company is going to be a very different evaluation. Anyone want to jump in? No. Okay. One of the questions that we have after that is what assurances does the bond provide? And we know, based on our conversation last time, that there is this financial piece to it, right? Money that the surety has said that they are willing to, in the event of a failure to pay for grain or redelivery of stored grain, here's a set amount of money as determined in statute that will be available to all claimants. And in Minnesota, it's a pro rata share. So if we have 3 or 4 claimants that are claiming 100,000 or going after $100,000 sum, it will be based on their percentage of the total claim. So we're not paying out each claimant $100,000. We are paying them their portion of the total claim. One of the things in getting into question number 3 is the bond an endorsement of a company in their financial position? And Adam, I really hope you can shed some light on this. I don't know if people are purporting that or trying to like sell that as a advantage to the bonds, but it is a perception that if you are licensed and bonded, that you are in a good financial position. And go ahead.
Yeah, I was going to say, endorsement's kind of an interesting word. I would say that if a surety is issuing a bond, it has, after studying the financials of the company, it has made the best decision that the company is going to remain solvent for the next, usually it's every year that the bonds are renewed, that the company is going to remain solvent for the next year, and the surety is going to guarantee the bond amount. And in the event the company becomes insolvent, then the surety is on the hook for the full bond amount.
So it's not like a stamp of approval, but it's an evaluation that each surety makes of the company. And that's what we kind of talked about last meeting as well. Great. I'm putting you on the spot, Adam, so I apologize. You're the only one responding at this point. So
I was volunteered by my members to be here today, so I'm happy to be here with you.
Again, thank you very much. Oh, Jim, it looks like you got a question.
Well, I think that the bond, the question about an endorsement for a company, I think in the past, it was, easy to say you're bonded, so that, it's great. But after the, the number of failures we had, I think at that point in time, people became more aware that bonding really wasn't covering, a significant portion of potential liabilities from a grain elevator going down. So I think the perception has changed at this point. It's my comment.
Are you hearing, Jim, if I can just dig into that, are you hearing that from people selling grain to you, or are you hearing that from other elevator managers? Like,
I think
I'd just like to understand some context.
Yeah, I think it's more prevalent after Global and Pipeline went down, that there were so many players that are on the hook, and they're not going to get a penny on a dollar out of this thing. And so that word has traveled pretty fast.
Yeah, I can say that we have heard that as well. That the 5 cents to every dollar that the recent failures have paid out has definitely change the perception of the bond. And that's why we have an indemnity fund now. Let's be honest, that's a large portion of it. The payout amounts that we saw in those bonds was a big motivating factor for the indemnity fund here in Minnesota.
I think also, if I can expand on this, I think also an awful lot of people believe that, the company's bonded, didn't understand this cash basis 30-day, after 30 days, it's a voluntary extension of credit. I think there was a lot of confusion with that and still is. So again, I think people are getting more educated about the fact that bonds haven't covered a significant portion of a loss, particularly in these last bigger events.
Yeah, I just wanted to add to that, Jim, processing the claims for these and going through the bonds with people who made claims. When I first started and we went through Ashby and we went through Carlsted and we went through some of the claims that we did earlier on in my career here, that was the expectation. People made a claim expecting that they were going to be made whole when they saw, oh, I'm doing business with a bonded company. They just thought, I'm good to go at that point, that I'm covered. So I agree with you also, Jim. I've had more calls nowadays where people are asking, what is my coverage? How well am I covered? Before we had the indemnity fund, especially people kind of on the Minnesota-Iowa border would call in and say, where should I be selling my grain so I'm most covered? Should I be selling in Iowa? Should I be selling in Minnesota? So I definitely saw that as well.
It looks like you've got a comment or question.
Yeah, I just had one comment. Yeah, I've read the many news articles about farmers not receiving what they were owed due to the grain elevator failures, and I completely understand the concerns. But if the bond amounts required by law are not reflective of the risk that farmers face, and we averaged about 500 million in bond premiums between 2016 and 2020 in the state, and now we have an indemnity fund of like 9 to 15 million. There's going to be a relationship between how much you pay for your bond or indemnity fund coverage and the benefits that are available. So bonding is cheaper, or at least on a dollar per dollar level, but the coverage is less. And when there's a failure, it's a problem. So I know that you heard during the last legislative cycle that the bond amounts were probably too low, and I think for the most part we would agree with that statement, that when there is an insolvency and you only have $125,000 for the grain elevator, that's just not going to be enough.
Yeah, and we've had the conversation in multiple legislative sessions on it. If we adjust, what do we set these bond values to? Like at what level is it enough? And that's a hard thing because we're painting with a broad brush here with legislation, right? South Dakota has Christine, correct me if I'm wrong, South Dakota has a sliding scale with no cap. So it ends up being significantly higher bonds, but having no cap is also a scary endeavor for some companies that are dealing in billions of dollars worth of grain. So it's.
I saw South Dakota bonds for one location in South Dakota that were quadruple, if not more, than entire entities here of the same company. So they were here holding a $500,000 bond for every single one of their locations. In South Dakota, they were holding a 1.5 or $2 million or $2.5 million bond for one location. So very different over there.
And Laura, maybe you can chime in. Like, I think it would be a hard sell to ramp it up to such an extreme, right? Like I feel like we have heard that in the past, and I don't want to speak for MGFA here, but that people would definitely have some reservations if we just immediately flip the switch to a similar scale or bond schedule to that of South Dakota.
Yeah, I would probably agree with that. But I don't, I think industry has a better sense now that, yeah, we probably do need to increase the bond amounts. Do we want to go 0 to 60 like South Dakota right now? No, but if we stepped it up over a period of a few years, I think that would be a much easier pill to swallow.
And Laura, is that like in addition to the indemnity fund? Or is it covering some other transactions that the indemnity fund doesn't cover? Like, hey, I mean, that's the other option here. We have an indemnity fund in place today, and bonds are no longer required except for new entities. So if we were to re-implement a requirement of bonding, does it just go back to the old system and we just up the values, or do we say, well, we understand that there's a gap in what's covered here in the state of Minnesota right now? Only producers are allowed to file for the indemnity fund, and any sales between a primary purchaser and a secondary purchaser, like a small elevator going to a ethanol plant, well, that isn't covered, and so we require that to be those transactions to be covered by bonds.
Or does it go to pay back the indemnity fund? Say it's kind of the elevators, if there's a failure in an elevator, pays out the indemnity fund and the bond pays the indemnity fund back.
That's how the language is written. Oh, sorry. Go ahead, Laura.
Personally, I'd prefer not to see the bond pay back the indemnity fund. Producers wanted the indemnity fund. They've got it. That is their insurance to pay for. I would be open to seeing bonds be increased some. I do think that they're too low right now. So I do think that we probably should raise bond rates if bonds come back into play. And I think it would be great to be able to see unsecured creditors be able to make a claim on that bond.
Unsecured credit, to clarify, unsecured creditors that are selling grain or transacting in grain, or all unsecured creditors for a facility that goes under?
I don't know. I got to think about that one, Nick.
Right. Great conversation. I really appreciate everyone jumping in here. I've got several more questions. We've got 20 more minutes. Oh, go ahead, Jim.
Well, I'm struggling just a little bit as to why we're revisiting bonds when we've pretty much proven when we went through this process that they were inadequate in covering a significant portion of claims. And then, as I indicated with the voluntary extension of credit, if you're not doing a cash sale, which is very, very common, by the way. So now, unless the bond companies are going to say, well, we're going to cover for a longer period of time, we're still, there's still no coverage for somebody after 30 days. And that's where an awful lot of sales are. People are wanting to adjust for tax purposes. They're wanting to see what the market's doing. So, we've put the Grain Indemnity Fund in place, and that has really solved some of that issue. So I'm sorry, but I just don't know why we would put bonds back in place on top of the Grain Indemnity Fund, but you can enlighten me. So.
Yeah, I mean, I will do my best, and by no means am I going to provide the most comprehensive answer. But to answer your first question, why are we revisiting bonds? Well, we've been asked by the legislature to discuss them in the context of providing the best protection for producers possible. So that can mean all sorts of things. That can mean re-implementing the need for bonds. It can also mean continuing down this path of not requiring them except for new entities, or changing it in some capacity. The indemnity fund as written is certainly a change from what we've done in the past, but we haven't had any claims against it. Like until we test that system, I helped write it, and I'm skeptical that it's the perfect system, or a system that's going to address all the issues here in the state. So the other thing I want to provide context to Jim's point, for those that are unaware, is that previously bonds covered cash sales and stored grain. Voluntary extension of credit contracts were not covered by the bonds that were required under our law. And the indemnity fund has implemented coverage for those voluntary extension of credit contracts. There's caps and changes on how varying levels as to how those are reimbursed. But so a producer selling in Minnesota today under the indemnity fund is afforded different protections than they were afforded under the bonding system that we had prior to 2023. All right, I'm going to continue down the path of these questions. If please feel free to jump in with any other questions or clarifying questions if you see fit. So, and I apologize. I sent something like 18 questions on. I'm going to skip around a little bit, Adam, for you who has it in front of you. But one of the big things we've asked is or like really questioned internally is what financials are required. Is there a standard out there? Or is it really based on the business and how they are operating? And is there a tiered system? Like if someone has an audited financial, do they need to provide anything else? And I think based on your response, I don't want to put words in your mouth. It's going to differ from company to company, but maybe you can provide a little insight into like the kind of financials that are accepted, or maybe it's really each company is different.
Yeah, I've never been on the underwriting side of the business, and I can provide a more comprehensive answer, I guess, to you via email. And I apologize to those of you on the call for not being able to provide a comprehensive answer now. But our members bond companies of all sizes, and we will take whatever financial information that the company is able to provide to us. And if we have additional questions or need additional documentation for anything, we'll go back and ask for that information. But some companies, if they provide that audited information and there's no reason to ask for additional information, then there's really no reason to continue evaluating the company. My guess is it's more or less like a stoplight. You get a green light, you're done. You get a yellow light, you ask for more information. And then if there's something concerning, then you try to figure out a path to make sure that you can bond the elevator. Or if you can't, then you just say, hey, thank you, and please, we just can't make this work this year.
Great. Laura, I know you help with some of your or have some involvement with the underwriting and the bonds that you guys work with. Do you see a range of financial reports, or is it mostly audits and reviews that when you are facilitating the securing of a bond?
I don't know. I'm on the trade association side, and I don't participate on the underwriting.
Laura, how about you?
Yeah, I don't do any underwriting. I don't assist in that at all, just for clarification. But yeah, mainly the financial reports end up being reviews or audits.
Christine, do you have a question?
I was just going to say, when we were at the Association for Grain Regulatory Officials, I did talk to a gentleman from Nationwide Agribusiness and asked him kind of the similar question about what financials are required, particularly for small businesses, because I think that when we talk about bonds, in the last session, we talked a lot about financials and how, in the old system, bonds were used as kind of this tool to make sure the financials looked acceptable. And that's why at that point, we didn't need to obtain financials. And now we are obtaining financials. And I asked him, what they accepted for these smaller companies. And he said, a lot of times they will accept these lower level items like client prepared financials, tax statements, looking at their FICO, their PayNet for small businesses in lieu of a review or an audit, because a lot of those companies don't have reviews or audits. And that's what we found too, right? When we went out in 2020 and we said, hey, we need all of these companies, whether you purchase $1 in grain or you purchased $1 billion in grain, we're going to need you to submit some sort of review or audit. People who were at that lower level purchasing lower levels of grain were not getting a review, they were not getting an audit, or they were getting a compilation maybe instead of a review or an audit. And those things were being accepted by their bond companies. I think, Frank, you're on the call. I'm not sure if you've always done an audit or a review, maybe lower level, but you were always getting a bond. Maybe same for you, Jim. You were always getting a bond, but maybe not having to do these higher level audits or reviews. And I don't know if we should, it's kind of just going back to financials a little bit, or keeping financials in this conversation, how we can move forward with accepting all types of financials if that's what bond companies do as well. And that was good enough at that time.
Yeah, to build on that, Christine, like what, and maybe it's just a summary of what you said in a little simpler terms. Like there was a standard, there was this requirement to get a bond, and like the standard for financial was whatever you have at your fingertips, right? Whatever you can provide to give us a clear picture of what you're doing. Well, when we implemented this requirement for financials as a review or audit, that was like 0 to 60 again on for many of our license holders. And so maybe we need to walk that back here in our recommendation and acknowledge, like, we asked people to run when they weren't walking before, and a lot of the industry, the way our law is written, a lot of the industry is small players. A very large portion of our license holders are small entities dealing in less than $5 million of grain annually, and we acknowledge like that the burden of a financial is not equitable compared to other facilities. So again, we're tasked with writing a recommendation and creating a bare minimum to operate here in Minnesota and purchase grain. And so like, we are open to any and all suggestions as to what that looks like. If it's the department evaluating financials and making a determination on your financial position and then issuing the license, or if it's having a third party do it in the way that we used to have facilities bonded. We just need to be aware that like when sureties were doing it, it's not a standard system. And if we are requiring the state to do it, we need a very standard system so people are aware by which the manner by which they're being evaluated. So I'm going to jump ahead across these questions. As I'm going, if you see a question that you really want to answer, please just flag me and I'll go back to it. But well,
Go ahead, Frank.
I'm sorry.
My understanding is that there's tiers to the financial statements. There's a reviewed, there's the lower level financial statement, and then there's the audited financial statement. Is there some way of implementing that to get the guys that are on the fringe of it, that you could either make the decision at that point, hey, this guy needs an audited financial statement, the reviewed financial statement is not going to cut it?
Yeah, I think again, like, we have the capacity here to write whatever recommendation we see fit. And it's not just me. I'll be writing it, but it's based on the feedback from this group. So it's this group coming together and helping to formulate that. There's other states that do like a 3-year average and monitor based on a 3-year average, and then have a trigger if they identify something in evaluating their financial position over time. So like I feel like there's probably a model where we say, here's the requirement, but if you meet these certain standards, maybe you don't have such a high requirement for reporting moving forward as long as you meet certain metrics. certain exemptions permitted under the law besides just the cash sales. I don't know. I've certainly got ideas, but I am going to be the first to say that they're not perfect. So one of the, oh, go ahead, Jim.
I thought it was pretty interesting at your last meeting. We looked at, you listed financial history, 1982 financial statement required, 1983 compilation, 2004 review or audit, then 2005 it went to like an exemption, then nothing in 2012, you know, so there's been a history of changes here where reviews and audits really weren't the main requirement for most of that time frame. And you know, I'm a real small player, so it's a different system for me, but you know, my bond is so small, I have really provided very little information, or the need to. Maybe they get the information off of Dun & Bradstreet or something, I don't know, but I provide something if they need it, but certainly not a review or an audit in the past.
Yeah, that history that you mentioned, we did away with the most recent time we did away with financial reporting, which, oh shoot, I don't have the presentation in front of me, but, or the date in front of me, but it was 15 years ago, maybe less, 2012, 2010.
That's what it
The
says.
reason,
No financial 2012.
2012. Okay. The reason that went away is on the premise that the sureties were reviewing financial position for each and every entity. So why require them to report to the department as well as report to the surety, and then have the surety do the screening and issue the bond? They said there's no reason to duplicate that effort. And so we went away from the state requiring it. That's the context of the change. I wasn't around then. In fact, most of the people on this call, I don't think were in the same positions they were in then. So, you know, this is all based on what some of the people that we've had in the program for decades. All right, so one of the questions I had after a comment that Laura made last meeting was that the sureties are evaluating some things, sometimes some things besides financials. And I think there was some components like certain covenants or other programs that were being evaluated. And so my question to industry is, you know, what if any protections do those provide? Like, is we talk about the dollar figure, we talk about the review of financials, but are there other things that the bond is doing that that people value? We heard people say we like having the bond because it's a third party coming in and reviewing our process here. So are there other values here besides just the financial review and that dollar figure that's set aside?
This is Adam. I'll mention that in many cases, when issuing a bond, especially for the operation of a business, the surety will screen for felonies or recent personal bankruptcies, because if you're going to be handling money, then you need to have a pretty solid record of not taking money or not recently coming out of bankruptcy.
Great. That's really helpful. And Christine, please jump in. We've heard of other states that are talking about or either doing it or talking about implementing a requirement for people who sit on the board or in management positions to report any related crimes or felonies prior to the approval of a license. It doesn't necessarily disqualify them from serving in that capacity, but at least makes the department aware.
Yeah, I think Nebraska. I think Terry from Nebraska had talked about possible background checks. I'd have to double check with her on that, but I do think that other states are doing some of that sort of digging.
I think in talking with other states in the Grain Regulatory Officials program, that is one of those things that that makes sense, right? Like we should be looking into the people that are running these businesses to make sure that there isn't some sort of criminal history there. That seems like a very basic level of screening. But I also understand like that is putting people potentially hindering business based on background check, and people are entitled to restitution and you know, if they've served their time and as deemed by a judge or jury, they should be also permitted to continue to be contributing members of society. So I can see both sides of the coin here.
I had one question, Nick. You kind of have brought up a couple of times that in our last meeting, we heard that people liked having the bond. And I kind of wanted to dig into that a little bit more. If that people like having the bond because they like having the surety look at their financials, does that mean that they don't want the state to look at their financials? Or what role does the MDA play? What role do you guys think we should play within financials? Should we be looking at them and making determinations on somebody's you know, worthiness to hold a license based off their financials? Should we not be doing that? Kind of just wanted to know what people thought about the MDA's role. Go ahead, Frank.
I absolutely think that that's a great idea. There needs to be as much oversight as possible to give a degree of comfort to these people that are trying to deliver product and hoping for the best.
James, I see your hand up. Was that in response to Christine's question or something else?
Kind of. It went together with the question I was kind of thinking. Just thinking out loud here. Maybe the bonds could be used in lieu of the state looking at it, keeping the state from staffing up for that and finding the right people who can look at that. But I think the problem with the bonding, as it has been, the cost of the bond, the dollar amount we've done is so low. The risk of the surety is not high enough to necessarily drive the right amount of looking into things. So that might be a way to get a check into financials and different things in the background. And you just have to raise the value of it to make it more likely they do the due diligence they need to do.
Yeah, and I don't know if you were on earlier, but that's kind of the system that South Carolina has, where they allow for an exemption of financial reporting to have an additional bond on hand. So, Stu, did you have a question?
I saw James has his hand up too.
Sorry. No,
That was me. I'm good. I answered I got what I
Oh,
wanted.
got it. Sorry.
I was just gonna to clarify, so that would be an option for an optional bond, because I would be like, just from, you know, speaking for farmers union, from the farmer perspective, the cost of those bonds get passed on to farmers. They're pretty expensive, I think, compared to an FTE at the Department of Agriculture, and so would then farmers be being asked to shoulder additional financial burden for those bonds if they were mandated again at a higher level, in addition to the indemnity fund. So just another perspective, but that might change if what you were saying changes, that it was like an, you know, an optional alternative to providing financials to the department. But
Yeah,
In
so
my mind,
that's
it would be a cost mitigator. You would make the choice. Do I need to go the bond route, or do I already have audited financials, and therefore that's already that cost associated? So to me, it mitigates cost for everyone.
Yeah, that's a really good call out, Stu, that we have heard that you know, the costs often get passed on to the people that are selling their grain to these facilities. And so I will say, though, it's probably 6 of one, half dozen of another. If it's a $20,000 financial review or a bond, like, each company is going to have to make that assessment on, you know, how do I provide the best price to market or to get grain here. So it is going to be this, for some companies, they are going to certainly weigh which one gives them the better ability to do business. And I will say that like every company has a different structure, right? So like some people have to do these reviews and audits because it's in their bylaws, it's in you know, maybe they're a cooperative or something like that, and they need to have transparency for their members too. So it looks like we got another question. Jim, go ahead.
Yeah, so just reviewing the notes from before here last time. So cost $6,000 for a review, $25,000 average for an audit. We talked about a number of 4.5 million being passed on to farmers, basically, you know, or being absorbed somehow in the industry. And then again, I think, you know, we realized through the previous year or two when we were on this committee that the mechanism, you know, for analyzing these financials doesn't exist at this point in time. So again, there's this struggle in my mind as to why we're required to spend this kind of money if we don't actually have, you know, if we're not really achieving the goal of having somebody actually look at this stuff and seeing anything. And then I think also I made a comment the last go around that it's not easy for you to shut a business down that hasn't failed. That's really not your goal, is to start hampering businesses that are when we're trying to stimulate commerce in the state. And so there's lots of issues here with continuing to want these reviews when there's no mechanism for the analysis.
Yeah, that's a great point, Jim, and that's been unmentioned to this point, which is like if we do continue to require these, and we heard it from several people, like if we continue to require these, we really do need some sort of metric or evaluation spelled out, or at least something official, some official stance from the department on how we do that. One of the things that we've heard from some of the other states is they like very rarely do they immediately shut a facility down. Of course, a large scale failure or very poor financial position would warrant that, but in several instances, they will also just move to a more frequent monitoring program for financial information. So that might mean a monthly or quarterly reports to the office, to the state that is tasked with licensing them. So you know, that's one of those considerations that as we're writing a recommendation, maybe we talk about the mechanism by which we evaluate and then what that triggers. Does that trigger the department to go in and create a monitoring program? Does it trigger us to shut it down, take it over? Like I would advocate that monitoring is the first step. And we, you know, move to some sort of 3 strikes program or something along those lines. But we also understand that that's a slippery slope too. Go ahead, Robert.
Thanks, Nick. Rob Tate. I'm a corn soybean producer in Cannon Falls. I'm also on the Minnesota Corn Growers Board, and I just wanted to add a few things in here. And my schedule isn't going to allow me probably to stay until the end of this, but I did just had a few thoughts as everybody's talking about this. I understand there used to be a requirement for everything to be bonded, every grain merchandiser to be bonded, correct? And the indemnity fund in that process was removed. And as we've talked about some of this stuff, the pros and the cons of the bonding process, as a producer, I would feel much better about delivering product to a merchandiser that is bonded, that gives me some sense of security that somebody has looked at their financials and said they have the wherewithal to pay me. With that being said, I think when you start looking at this, if this is the route the group decides to go in terms of this bonding, the sliding scale thing makes a lot of sense. The smaller businesses, if they don't need as big of a bond, the cost to them isn't going to be near as much as those audited financials. And, you know, if they're a smaller business, they're not going to want to pay for that accountant to do those. And the bonding source is going to be a better way to do that and have some expertise within that industry to determine that, yes, this entity is financially viable to operate. I guess my feeling is towards the group is I'd like to see this bonding requirement be restored recognizing the fact that we probably aren't going to be able to feasibly anyways require bonding to be so high that it's going to cover a loss. We have the indemnity fund to shore up that gap. You know, the farmer ends up paying that indemnity fund in the event that, you know, it needs to be. I mean, once it needs to be funded more, it's going to come out of our checks too. So I would like to see that there is some level of due diligence being done here, and kind of a belt and suspenders approach, if you will. I mean, we get the bonding thing set up such that we've got that due diligence, and then the indemnity fund covers that gap in those larger indemnity situations. So those are just my thoughts. I wanted to add that to this discussion, I guess. Thank you.
Yeah, thank you, Robert. Yeah, one of the things I want to just add real quick, we're over on time, and so this meeting is being recorded. If you need to drop off, we certainly appreciate and want to honor your time here. We will send out the YouTube link for you to review if you need to, and you can certainly send any comments or questions to us. One of the things we heard in the last meeting, Robert, I think you were in attendance, was, you know, a surety evaluating a company. They're evaluating them, but the standard isn't the same across the sureties. It's not the same even within the surety, depending on the level of the business. And so, like, is that screening enough? It sounds like you are comfortable with that, but is that screening enough to warrant the department to not need to review the financials and create a bare minimum for operation? And that's ultimately the question that we need to answer here in developing a recommendation. And again, the financials and bonding are linked. They're hand in hand here, and so it's all part of the same conversation in terms of what we require. All right, looks like we've got a question in the chat. Oh no, all right. I've just got one more question here, and then we'll call it for the day. And again, thank you everyone for staying on past our time. Ultimately, and it's a very basic and open-ended question, how does a bond better protect farmers who sell and store grain in the state? And that's the question we've been tasked by the legislature. And I'd like to hear from those people that have been in attendance today, what their opinion is here on if a bond does better protect farmers or not. Alex, go ahead.
Yeah, can you hear me, Nick?
Yeah, I can.
Oh, perfect. I'm in the car. I just had one question, and maybe you were about to get to it, but are we going to do this similarly to last year, where you'll be looking for written comments as well as the new year? Or, okay.
Yep.
We will clarify that.
Our report will include a summary of what we've discussed, and then last year what we did was we wrote the report. We didn't quote anyone in the report. But then we allow everyone to provide written commentary or written perspective, and we'll attach that to the report. So we will solicit that here as we're preparing to write the report in the new year.
Okay, thank you.
Yeah. Anyone want to answer the question, how does a bond better protect farmers who sell and store grain in the state? Oh, Jim, go ahead.
Well, I guess, it's become aware to me that it doesn't protect a very high percentage. And so that's why we went to the grain indemnity fund. And so I'm really happy we have this protection that is not just a 30-day coverage on cash sales and only a small portion of that if there's a large enough failure. So I think it has a place. To go back to your previous question, $6,000 for a review and a couple $100 for me to have a bond. Yeah, let's go back to bonds, just because, I'm just kidding. But there's a huge difference in what you're looking at here when what you're requiring. on the financial side of this, because, you know, these smaller bonds, there isn't an awful lot of cost to acquire that bond.
Anyone else?
This is Adam from SFAA. I guess I need to answer this question, or at least try to. I would say that bonding does a lot of things right now that you're trying to figure out how to do at the state level. How do you screen applicants? How to be sure you're getting quality people running elevators? What's a fair way to examine financial documents in a way that doesn't punish small business owners? How do you secure a financial guarantee? And as I mentioned, we believe the financial guarantees under the old law were probably insufficient and led to a reasonably foreseeable situation where farmers weren't going to get their money in the event of a foreclosure. And perhaps one way forward is to look at some combination of bonds and indemnity fund to protect in the case of an extreme bankruptcy to make sure that farmers are able. But at the same time, you get all of the screening and financial management and coaching that the bond does, as well as the financial guarantee that, based on available evidence, that the individual is reputable. The individual can run the elevator, and the elevator is probably going to be in business at the end of next year. Granted, I'm very cognizant of the one individual who committed massive embezzlement, and I don't know if there's a reasonable way to foresee anything like that. So the system isn't perfect, but we think the charities can have a place to do a lot of things, and they solve a lot of problems that you're looking at now.
Thanks, Adam.
Is there a recommendation going forward on audits, whether they're optional or required?
I mean, I don't think we've established that here yet. If I were to write the recommendation today, it would, if I had to write up the report today and had to answer this question, how does a bond better protect farmers? I think my answer would be a combination of what we've heard, which is it offers financial review. There's money out there that the surety is backing the company with, but the level of review isn't standard across industry. And so small companies, I mean, it's the 6 of one, half dozen of the other. Small companies are afforded more flexibility in what they can report to the sureties, but it has no minimum standard for financial position. So I think we do need another meeting here, or at least a conversation, maybe offline in distilling this. That might mean me sending some questions to the group as a whole to get some responses, just to kind of distill the recommendation. I'm not hearing a clear unanimous recommendation, and if I'm being honest, I had no expectation for that.
So if a conclusion was to come forward, is it something that comes in the next few months or a year, 5 years, 10 years down the road?
Yeah, I mean, we certainly have an obligation to report what was discussed here and give everyone the opportunity to comment on it in a more formal capacity with written testimony. And that's due, I believe, February 14th of 2024. So certainly something coming, but the recommendation doesn't guarantee legislation. Right. Any other comments? Question? Okay, well, go ahead, Frank.
I guess at this point, my opinion is that there has to be one more level in there. If you're a super large, have a lot of exposure, I can see the need for the audit, probably in conjunction with some kind of a guarantee from a third party. But for somebody that's somewhere in the middle, they're going to get caught in the crosshairs. And if you could have a reviewed financial in addition to some kind of additional bonding requirements, so that, like was said before, if the bonding requirements were higher, they would be taking a harder look at the financials. That is somewhat palatable, I guess, in my opinion.
Great, I appreciate that. Thanks, Frank.
This is Christine. I also want to be cognizant of, if we make these bond amounts higher in order to do that, then what and where does the bond amount go? If there's a failure, where does it go? Does the bond just not pay out anything? You hold a bond that really doesn't pay out anything? That I would kind of want to know, what does it do? Where does it go? Who does it help? Who does it protect? Is it protecting farmers? Is it not?
You mean
Christine,
that
this
dollar? Oh, go ahead, Adam.
Yeah, this is Adam. I suspect it could be structured where the bond would be the primary payer, and then once those funds from the bond are exhausted, you'd find what liabilities are left, and then that would go to a secondary fund. But the bond would pay first.
We would have to probably restructure our law somehow, because when we, before the indemnity fund, when we were paying out bond claims, the process was so long that we essentially bankrupted people while they waited for their bond payout. We had people lose their farms in the 1, 2, 3 years that it took to get the bond payment out. And I'm not saying that that was because of the bond companies not paying out. I'm saying that, our law said that we had 180 days in order for them to get a bond claim in, and then we had to do our investigation, which took a while. Sometimes it would have to go to court, and then it would get caught up in the legal system. So, and the indemnity fund helped solve that. So we would definitely, in my opinion, never want to put the bond in front of the indemnity fund, because we want to get people paid out and not bankrupt them in the meantime.
It's something that we'd have to explore if we reinstate these, and really, I would advocate that we start with a clean slate and try and understand what other states are doing, or how other bonds are structured, to make sure that timely payments are made. But ultimately, like, what I'm hearing here, and I may be off base, but I'm hearing that the financial review is the more important component of the bond. It's not the money set aside by each surety for each entity. It's great. It's the icing on the cake, but because there is some protection there, but ultimately it's that financial review is the more valuable part. That's what I'm taking away from this meeting. I will re-listen to what everyone said here, and certainly come at it with a new perspective, but I think that's what I'm hearing.
And I guess I'm kind of hearing, this is Christine again, that it would be preferred, people would prefer that the bond companies do that review versus the state, and maybe in lieu of the state obtaining a financial. So I would like to also kind of understand if people want the state to, or the MDA here, to stop obtaining financials completely, or maybe a lower version of a financial, and have the bond company continue to look at those financials. Again, kind of what is the MDA's role?
Go ahead, Jim.
Well, the struggle is the staffing, the expertise, the time. We went over this before. If the financials, by the time somebody gets them or reviews them, are 6 months to a year old, and they sit on a shelf someplace, it gets to be kind of hard to, there's a history. I don't have any problem sending in my tax returns or compilation. But if we're spending this kind of money, and there really isn't, a system in place. And I don't, we've heard today about the bond companies are scrutinizing, and maybe they are at a higher level. I haven't seen it, but I'm at the lowest level. So maybe that's not worth their time for me, in that sense. So, but I don't think we need to be, doing a review on the smallest companies that are small grain buyers, I would think a compilation would be adequate. Because what are you doing with it? You're looking at to see that it's we've filed a tax return and we've got somebody else looking at it. I don't know, but I'll stop there.
Thank you. I appreciate that, Jim. And we certainly hear that too, that if we don't re-implement the requirement for bonds, like then the department should be doing something with these financials. To have them go and sit on a shelf is not serving the purpose that's intended. To have staff committed to this at the department, it's probably not like a whole team of people. It's probably one person whose job it is. But we have 300 some entities reporting financials to us. So maybe it's a little more than one person. That's an evaluation that we need to make too, as we look at what this recommendation is here from this group. All right. Anyone have any final commentary before we end it? Again, I apologize for going so far over today. No, well, thank you everyone for attending. If you have any commentary that you want to provide, feel free to email Christine or I at grain@state.mn.us, or you can give us a call at 651-201-6011. We will likely schedule another meeting here before the end of the year, just to make sure that we capture everything that was discussed in these last couple meetings. And again, we will provide the opportunity for everyone to provide written testimony to be included in our report. So thank you all for your time, and I really appreciate the discussion today.
Thank you all.